Hello, this is Brian Resney, President of Resney Wealth Management, bringing you an important update about the economy and the investment markets. We're firmly into 2024. One of the things I want to stress to every client, as I do on every update video, expect volatility. In fact, I expect volatility a little bit more in the first half of 24 than the second half of 24. It doesn't mean that things are going down 50%. It just means I would not rule out a 5 or 10% pullback in equity values the first half of the year. It may not happen. We may be up 10% before we're down 10% or vice versa. But volatility is extremely normal. And again, I want to stress that. Our clients have done quite well over the years. And one of the things I want to stress to every client is when you have a big banner year like last year, every year is not going to be like that. You're going to have some years where you make 3% or you make 6% or you're down 3%. These things can happen. So again, adjusting, making sure people realize things can go up, things can come down, but over the next 3 to 5 years, I will continue to say I look for some promising opportunity out there in the U.S. economy. We've made some portfolio adjustments as we went into the last quarter of last year, which proved to be right. Did a little tax loss selling, but more on relative strength on the gain side. We continue to own oil, healthcare, which we beefed up positions in, and also on the technology side. We're looking at areas that we firmly believe the next 3 to 5 years will have some great opportunity on growth. And again, our oil exposure may change depending who's elected into the White House in November. It's going to be an interesting election year. There's going to be a lot of talk, a lot of back and forth. One of the things I want to stress to our clients is this. When Trump lost the last election, whether you liked him or not, we did have a few clients that said, well, should we be raising cash because Trump didn't get into office? You cannot manage your money that way, folks. I want to stress that. Maybe you don't like a current candidate or maybe you like another candidate more. But the key is by doing short-term emotional adjustments to a portfolio, really prove wrong for those few clients that said, hey, should I raise some cash because Trump didn't win the election? So Trump may win this time, he may not. And again, as you know, I always talk politics. Depending who gets elected in November, we'll make a portfolio adjustments accordingly. Whether there's a Democrat in office, whether there's a Republican, both parties spend money, or we wouldn't be $34 trillion in debt today in the U.S. So remember, they all spend money, just in slightly different areas, and we will adjust some of our thinking and strategy based upon who ultimately becomes the next president in the United States. It's going to be a long process, though, I will stress that. If you look at the general economy in the U.S., it's doing well. The employment numbers are looking good. The GDP numbers for this year are looking good, and so are earnings. So these are all net positives. We are not looking for a recession this year. Now, that may change in 6 months if data comes in different, but right now the economy is growing and it's rolling along in a positive manner. I can't say that so much for other countries outside the U.S. And again, one of the reasons we're invested mainly in the U.S. is because we're financially strong on the growth side, where other companies in other countries like Europe, as a great example, are not. Another area of fairly big concern, again, not invested in this country at all, is China. You know, there's a lot of talk with Taiwan and China. And the problem that you have with Chinese investments in general is they're not able to do what they need to do freely. The government really controls everything, and the accounting standards are lack. By having government control and lack of accounting standards puts a lot more risk on Chinese stocks. Now, while their economy is growing, they have as much debt, if not more debt, than the U.S. per GDP. So China's actually in worse shape than the U.S. on the debt side. Most people don't realize that. And again, they've borrowed a lot of money, have spent a lot of money, and ultimately I think their economy's probably not grown quite as well as it has. So again, we're mainly invested in the U.S. marketplace, not only in the bond side, but the equity side. We're going to continue that stance as long as that is the proper place to be, and we continue to grow the U.S. economy. As always, if you have any concerns about your portfolio, if you need a phone review, an office review, you have questions, give the office a call. And as always, we appreciate your business, your trust, and your referrals. Just so you know, our business grows a lot from referrals from clients like you. So keep us in mind. Because I will tell you, from what we're seeing in the marketplace, most of the people that were with the big brokerage houses and banks last year had a pretty lousy year on returns. That was not the case for clients of our firm. Proper money management is vitally important. Active money management and always looking out for you, the client, is our #1 priority. Have a safe and profitable day.